Okay guys, good morning. Let's get started for the session then. So, final day of the week, of course also final day of the month, and just looking at some daily charts here around the assets. And actually maybe let's just bring the S&P larger here and look at this on a monthly basis. This is the monthly chart for the S&P 500. Of course, bringing in the financial crisis and the meteoric rise up through the pre-crisis highs, October 2007. And just to kind of give you a measure, I mean, we haven't really moved much on this market. When you're looking at it over the long term, really, we've had 6 months of pretty flat activity. But to put it in perspective, well, if I go to the high of the year, that's 34.5% above pre-crisis highs. But if you look at, if I zoom in here, and just look at the last 6 months, then look at the tops of these candles. Let me zoom in even more. So if we look at the last 6 months, so we're just going to complete this month today, and I'm going to draw a bit of a line here. You know, anything around just above the 2,100 handle, anywhere around 2,100 has been the, you know, an important price point for the month. Every month apart from April for the last 6, and then you can see, of course, the tops of the wicks. Well, a lot of them are coming in around 2117, and ultimately we got the high of the year and the all-time high at 2134. But you can see that this is now for a very long period of time been a pretty steady consolidation range, having rallied, you know, pretty much uninterrupted, well, really since the 2009 low, I guess, but particularly really from sort of quarter 3, or I'd say quarter 4 2011 through till today. It's been pretty uninterrupted. Now we've got quite a nice little channel here. Look at these lows from March, from April, and now for July, all coming in almost bang on the same price point, around 2033. So we are tracking sideways. This month is almost going to be the exact opposite of last month. And if we close anywhere around where we are now for today's session, then look at the bodies of the two candles, the June month and the July month, and it's almost exact opposites. The body's pretty much the same size, and obviously different colours, different directions. So it's been another month where we've pretty much gone nowhere. When you're thinking about year to date, well, the market opened the year, the January start point was 2055, and that was the low of, well, the closing level for June, and it was the opening level for July, of course. And this month, as it stands, the market is up 2.43%, but it's very much still tracking sideways. If we go back to the daily, chart, then it's been a pretty choppy fortnight where we have had a big sell-off last week, and then continuing that sell-off on Monday of this week. Most of that down to the two big factors of China and then some US earnings numbers that have disappointed. But since then, it's been a pretty impressive rebound once again, but pretty choppy, quite decent intraday moves, but ultimately this market in the medium to long term isn't going anywhere. we stay glued to the 2100 handle. So it'll be interesting to see what happens as we track through the rest of quarter 3. We are now 1/3 of the way through quarter 3. We had GDP data from the US yesterday talking about quarter 2, of course, and it was a pretty tricky data release to navigate through, given the mixed data that was received. On the one hand, quarter 2 growth was lower than expected. We had expected 2.6%, but it was 2.3%. So we were 0.3% growth worse off for quarter 2, but that was offset by the fact that quarter 1 got revised higher, and quarter 1 is now up to 0.6%. the thing about that, and the thing about the data that was received yesterday, it makes a bit of a mockery of it, because this GDP data, the way it's announced. If I just bring in a chart here so you can kind of see what I'm talking about. Here's the GDP chart for the US. So we've got 2.3. This is the first reading for quarter 2. We'll get another update, and this will get revised in a month's time for the second preliminary reading. We'll then get a third and what's called, in inverted commas, final reading for this at the end of September. So this is going to get revised at least twice. But then if you take quarter 1, well, let me take you through how quarter 1's GDP has been reported. So at the end of April, we got the first preliminary reading for quarter 1 2015, and it was minus 1.2%. We then got a second update at the end of May, and it was minus 0.7%, so they revised it higher. We then got a third, and what was supposed to be the final reading at the end of June, which was again revised higher to minus 0.2%. Except that wasn't the final reading, because they revised it again yesterday, so it's now up to plus 0.6%. So if you just take quarter 1 growth, initially we were told it was minus 1.2%, and now it's up to plus 0.6%. So this has dramatically changed, which means this 2.3% reading that was delivered yesterday, there's no way it's going to be 2.3%. It's going to be revised one way or the other as we track through the rest of the year. So not only is it backwards-looking data, where you're looking back at April, May and June, but it's not really that reliable either. But it's all we've got to go on, of course. It's now the best reading we have for quarter 2 growth. But I don't think it's going to have too much of an impact necessarily on what the Fed are thinking, and that's the big topic, of course. The big market leading force at the moment is the Federal Reserve and their rate hike. And I don't think the Fed are going to be paying too much attention to this data. I don't think it's going to change their thinking necessarily. When you're thinking about the probabilities of when the rate hike might occur, well, we did get a very marginal movement on the probabilities for a September hike. We're now up to actually 48% chance that we'll get a rate hike in September, and now I think we're up to a 78% chance that they're going to hike rates before the end of the year. This does put September's meeting, it couldn't be more finely balanced. Well, I guess it could be 50%, but we're pretty much there at 50%, right? So we're going to go into a September Fed meeting 50-50. They might hike rates, they might not, which puts that as perhaps one of the most important, perhaps one of the most dramatic Fed meetings and Fed statements in recent times. So this September meeting is shaping up to be a headliner. It's going to be very interesting. Now, of course, we're 48% chance of a hike in September, but that's today. Obviously, that expectation will change as we track over the next 6 weeks. We've got 2 payrolls reports to get through before the September meeting. We reported on this yesterday, but the Fed added that word, a single word in their statement. They said some. We want to see some improvement in labour market conditions. And I would say if you get 2 payrolls reports that are somewhere around 250, then that is absolutely good enough for the Fed from a labour market point of view to hike rates. Except that it's not just about the labour market, it's also about the inflation situation. So you can't just look at payrolls to determine when the Fed's going to hike. You've got to be looking at inflation particularly. So, and that's something from the GDP report yesterday that was of note. The PCE deflator came in slightly higher than expected. So that's why overall you might say we got a very, very minor hawkish response to the GDP data yesterday, despite the fact that quarter 2 growth was worse than expected. So euro dollar ticked lower, so the dollar moved to the downside. The dollar appreciated in value. We moved down to test the 109 handle. So we got a bit of a nice sort of downward trend shape going on with this currency pair over the last couple of months. And there's no reason why that's not going to continue. What helped yesterday as well on the euro side was that German inflation data was marginally lower than expected. We're going to talk about this in a minute because we've got Eurozone inflation data hitting the wires at 10 o'clock today, as well as their unemployment figures. But for now, this cycle lower seems to be nicely continuing, having topped out at the start of the week. Another sort of pretty amazing foray above the 111 handle, but that hasn't lasted long, and we're tracking lower, and you should certainly target, at the very least, this double bottom, and it's an important level. It's the May low and the July low, the July triple bottom, if you like. Around about 108.20 is very important. Technically, if that gets taken out, I'm not saying this is going to happen today, no way. Never say never. We do have some data today, but I'd say we're probably too far off. We're over 100 pips above this 108.20 level. So I think probably not enough major news flow today to be able to get us down there. But I'd say as we track into next week, any kind of break below 108.20 technically will almost certainly set up a test of the low of the year, which is down below the 105 handle, the March low. Okay, so technically this thing is shaping, and this is the consensus view. I think most analysts are expecting euro dollar to track the lower in the second half of this year. You've got varying degrees of bearishness. Goldman's perhaps top of the list. Goldman's are thinking that by the end of this year, this market will be trading well below parity. And actually, by the end of 2016, Goldman's think this currency pair will be trading at 0.85. That's a bit aggressive, but certainly not impossible. But Goldman's central view there is that ultimately deflation in peripheral Europe will come back, and it will be back for a prolonged period, resulting in extended monetary stimulus from the ECB at the very same time that the Fed are making their way along their exit strategy route by raising rates and beginning to stop reinvesting their QE maturing assets and start to slowly unwind that $4 trillion they pumped into the system over the last 6 years. So I think nicely, technically this is still drifting lower. 108.20, very important. Probably too much to ask for today's session. Look at the Bund though. This is important technically. The Bund had a decent day yesterday, importantly breaking above the July double top. Well, it's not July's double top anymore, because obviously yesterday's high is now July's high, but look where we are. And again today's high, it's the 50% fib of this monster move to the downside that we saw over a 2-month period, mid-April down to mid-June. Massive blowout. Big move as yields on German 10 years hit the 1% handle. So that was back in June, of course, and now we've been tracking back a lot more slowly, but we're now finally back to the 50% fib handle. So a bit of an update on Europe, Greece, important, how you describe it, a kind of minor victory for Tsipras yesterday. The kind of the extreme left faction of the Syriza party that have not been happy with the developments of the last month. Tsipras, in their eyes, caving in to creditor demands, completely violating the mandate they were voted in to map out. And so the splinter sort of far left group want a meeting of Congress, and they want to basically alter the shape of the government, and this introduces political risk. But Tsipras has managed to win a sort of this little battle, and we pushed this to September. Tsipras' plan of action: get the third bailout deal done, get it agreed, get it locked in, then we can sort out the political makeup of the government. So it looks like September is now going to be the date where perhaps Tsipras, we'll see. He's already reshuffled the cabinet, of course, but whether Tsipras' coalition government will remain intact or even remain in power is a question. But for now, that's pushed beyond the negotiating period for the third bailout. So that's a minor victory. But we have seen yesterday reports from the IMF, and this is something I've been talking about for a couple of weeks, and this is the fact the IMF is saying, look, we can't participate in a third bailout unless there's debt restructuring. We need write-downs, we need haircuts. And this is not something that Germany are willing to agree to. So you're going to get a standoff between the IMF and Germany on the Greek situation in the coming weeks. August the 20th is the next kind of key date in the diary on this crisis. That's when Greece have to pay another few billion euros to the ECB. And of course, they don't have any money at the moment. But another bridge loan may be possible if the Europeans aren't able to agree on a Greek third bailout deal before then, and I would suggest it's unlikely they're going to get a deal done in the next 3 weeks given their track record. So we shall see on that front. Let's check in on oil. So you know what's going on here. An important second wave to the downside over the last 6 weeks. And this week we'd seen, if you look at Tuesday and Wednesday session, we lifted particularly on Wednesday as we got some surprisingly bullish inventory data. That's bullish for price, as we saw a 4 million barrel drawdown on US inventories. That got prices spiking higher, but look, it's already almost all been given back as this market drifts back lower, and it looks like we're going to continue to see this downward trend play out as we go through the next few weeks. $42 on the continuation chart is key. That's the low of the year. That's the low of this massive sell-off we've seen in the last 12 months. So, a lot of this is about China. So let's talk a little bit about China, because there's a lot of talk about the fact that Chinese growth, it's not true. That the figures that China's government report aren't right. And that China keep delivering numbers that are around 7% GDP growth, and there's a lot of skepticism about it. But it's hard for analysts to. It's hard to argue against the government numbers because we don't have enough information to prove that they're wrong. But certainly China risk is playing a huge role in the collapsing commodity market space of the last few weeks, and well, even the last couple of years really, but more specifically over the last few weeks, where you got particularly industrial metals getting hammered, things like copper down at a 14-year low, for example. Now, how can we better understand whether these GDP readings from the Chinese government are valid or not? Well, there's quite an interesting, just this week I would say, there's been sort of an interesting new source of information on this that absolutely cannot be ignored, and this is global corporations. We sent an FT article out on this morning. Global corporations, it's been a feature of the earnings season. Global corporations massively downgrading forecasts for their revenue output from their Chinese market. So, for example, Peugeot, the French car giant, in their earnings report this week, they slashed their growth forecast for China from 7% down to 3%. Ford predicted the first full year sales fall for their Chinese arm since 1990. Okay, so these are two big car giants. Is it a coincidence that Peugeot's growth forecast was 7%, which is what Chinese GDP is, and now they've slashed it to 3%, which is what some people think Chinese GDP actually is? So two car giants here making notable noises about their concerns about China. Other companies, so United Technologies, the China market has clearly slowed, they say. Real estate investment, new construction starts and floor space sold are all under pressure. Companies thought that China was the land of opportunity, but it's not living up to that promise. That's the United Technologies CEO. Other comment, and there's a whole raft of big companies kind of citing China weakness here. There's a big brewer, Anheuser-Busch InBev. This is one of the big global brewers. Thursday they said volumes fell 6.5% in their China arm. They cited poor weather across the country for this, but also economic headwinds. What about Schneider Electric? Another big global giant electrical equipment maker. They reported a 12% fall in first half profit, and they cut guidance, and their main reason was because weak construction and industrial markets in China. Other people, so the Schneider CEO was saying persistent weakness in China. What about Siemens, German industrial giant? They said their sales in China fell 8% in the quarter. They said Chinese new orders slid 2% when adjusted for currency swings. This is not a small number of companies, and the important thing about this, it's across sectors. Different global giants from different sectors, all citing notably accelerating weakness in their China output. So I think this is adding to the concern that China's slowing growth rate is actually slowing at a lot more dramatic pace than we thought, or at least that the government would have us believe. So add into that, obviously, the big stock market story, and this is a recipe for concern. Now, also, if you're looking at over the summer, because we're about to hit August, and normally, if I actually go back to my S&P monthly chart, and I'm going to add the volume bar, normally what happens in August, it's the kind of northern hemisphere summer shutdown, if you like, where you typically get everyone going on holiday, and so volumes dramatically drop, and therefore market activity dramatically slows. So if we look at this, hasn't been particularly obvious in the last few years. I'll talk about why in a second. But for August 2014, the August month, let me just see here, was I guess that's the third lowest month volume of the year. It's actually weird. November, we had the lowest volume of the year last year. In 2013, August actually was not bad on the volume front. If you go back to 2012, then it's again one of the worst months of the year. Go back to 2011, and here it completely bucks the trend, because August was comfortably the biggest volume of the year. So the point I want to make here is that actually there's a theory that August is a kind of global shutdown and volumes drop dramatically, but actually in recent times they haven't, and that's because in the summer we've typically got some pretty amazing events occur. If you go back to 2011, the S&P dropped 20% in the first 2 weeks of August, where we got sort of the perfect storm. This was when the Eurozone debt crisis kind of began to reach its zenith. We got massive concern on US defaulting on their debt. We also back then had a real China risk. Chinese inflation was jumping sharply. The government was trying to tackle it by tightening policy, and this was having a negative effect on our sort of growth outlook for China. So pretty much the perfect storm back in 2011. But as you track through these years, what's going to happen in August this year? Let's talk about that, which of course this is the most important thing because it's about to start. The S&P is mid-range. It's bang on around 2100. What is going to happen in August of this year? Now, there's obviously always two sides to the argument. There's plenty of stuff to be bullish about. You could say that Greece, the risk is dramatically reduced. You could say they're going to get their third bailout. You could say that one of the major risks for the first half of this year is gone. You could say that also, because of that, Eurozone economic growth prospects should improve, and that's because we've got the ECB still printing money at full speed. And have we really seen the effects of this stimulus yet? Has the Greek risk held back that kind of confidence that QE normally brings? And now that the Greek risk has gone, is this confidence factor going to start boosting growth in the world's second biggest economic region? So that's a positive thing. Also, you could talk about oil and the price of it. And again, this is particularly important for Europe because they don't produce much, if any. So what about this idea that the drop in the oil price is going to start to feed through in a powerful way from a consumption perspective? And this has often been the case in the past. When you've seen a dramatic drop in the price of energy, it often takes about 6 months for that to feed through in a meaningfully positive way in terms of consumer behavior. So maybe we've got a second half of the year where finally this low oil price is going to feed through and drive growth from the consumption point of view. So these are some positive things you could talk about. But then there's definitely some negatives. And the negatives would be the Federal Reserve. Are they going to start hiking rates? We've just spoken, it's almost a 50% chance of a hike in just 6 weeks' time now. If they hike in September, and if the data we get through the course of August from the US is strong and solid, particularly if wage growth numbers start coming in stronger, then they're going to hike. Now, what's that going to mean for the global system? I think we've got big problems ahead. If the Fed hike in September, I think globally this is a risk. And it's a big risk because notably the emerging market space is very weak at the moment, led by the China risk. If you get the Fed hiking in September, resulting in more dollar strength, plus then of course you've got the commodity space at rock bottom, well, that's like a double whammy for the emerging markets. A really strong dollar's bad news, and then a lot of these emerging markets produce commodities and export them to the world. But if the commodity prices have slid by to multi-year lows, well, then this is going to hinder their growth story. So, also you've got a deflation risk. This is something that nobody's paying much attention to. If you look at economies like Thailand, for example, they're in deflation. And it looks like it's going to be prolonged deflation. Chinese inflation's at kind of multi-year lows, even though they've been cutting rates a few times this year, pumping in various other forms of stimulus through a cut in the reserve requirement ratio. Well then, even that hasn't managed to boost any inflation, and a lot of this is because of the commodity market space, of course, but there is a real meaningful deflation risk in Asia that nobody's really talking about. And when you get stuck in prolonged deflation, then you have a problem. So I think there's a big emerging market risk to a Fed September hike. I don't know if that risk is going to be strong enough to actually persuade the Fed just for that reason to hold off. We'll have to see. I still maintain the Fed will hold off. I still think it will be December, except that my view on that is, let's say I'm less confident about it than I was, let's say, 6 months ago. Now that we're getting closer to September and the probabilities are shifting, I still think December, but that view is now less certain. But I think a September hike could tip the balance. I think that really could create a bit of a summer storm. So there's always two arguments. There's always positive and negative things to look at. And of course it depends on your view. For me, what is it going to mean for the S&P? It'll probably mean we stay in this sideways range. I would think that the range would stay flat, and I'd say there's a higher probability of the range breaking to the downside than the upside. If you look at US earnings season, we're about 2/3 of the way through it, and right now at the moment, revenue beats is just 50%. Only 50% of companies have beaten on their revenue forecast. And we'll see, but it looks like we could get the first quarter since the start of 2009 where earnings per share has actually contracted on the year. Okay, we'll see. We haven't got the number yet because we haven't hit the end of the earnings season, but it could be the first quarter for 6 years where earnings, that's profits, have actually dropped on an annualized basis. So we'll see how we go. Plenty of room to move within this range, by the way, on the S&P. It's a big range. It's a 100-point range. I'd say we stay in it with more chance of breaking the bottom. That's my view. All right, let's just quickly look then at the data that we've got hitting the wires today. I'm going to bring in my data calendar here. So this is what we've got. We've actually already had German retail sales figures. Let me show you the chart for that. Came in much worse than expected, minus 2.3%. We had expected plus 0.4%. So a really bad data release here. This is quite old though. This is for June, and here we are at the end of July. But weirdly, on an annualized basis, which kind of makes this reading a bit confusing, if I show you the annualized retail sales chart for Germany, then actually this is the best number for several years. So it's kind of a bit confusing here. On an annualized basis, very strong. That's June retail sales 2015 compared to June retail sales 2014. But then on a month-on-month basis, June 2015 compared to May 2015 is really bad. So a bit confusing, which is why markets haven't particularly responded to this in any meaningful way. But look, next data's at, well, we've got some figures at 9:30, but these aren't particularly important. So 10 o'clock's the next important data. We've got unemployment rate from Europe. We're expecting it to be 11%, which is, well, let me show you the chart for Eurozone unemployment. And so we're expecting 11%, which is a slight drop from last month's 11.1. If you're partially colorblind like me, then I assume you're struggling to pick out which country's which. I can't actually see which one's the euro area line. I guess you guys can, but it's 11.1, right? But look, the top two are the obvious notable. Well, first underperformers, but now their unemployment rate is quite sharply recovering, but they're still way above 20%. This is Spain and Greece, of course. So unemployment figures coming in firstly at 10 o'clock, but then also probably more importantly from a market reaction point of view will be the Eurozone July CPI reading, and we're expecting plus 0.2% on the headline, and we're expecting plus 0.8% on the core. Okay? So if we look at the headline, 0.2% will be in line with the last figure we got. There is a risk this might creep lower because the German figures yesterday were marginally lower than expected. If you look at Spanish CPI, that's at minus 1%. So we do have this peripheral situation where peripheral Europe is in still negative territory, and it's time's wearing on. If you're in the deflation trap for anything more than kind of 6 months, it's definitely like 12 months, and you've got a problem because it's then very hard to get out of that trap. But don't forget, we've got the ECB pumping money at full speed to try and reverse this situation. But the Eurozone as a whole is back in positive territory, and we're expecting another print at 0.2%. Okay. Back to the data calendar. So that's this morning. 10 o'clock is the data set that's going to be most important. This afternoon then, we have data coming out of the US. At 1:30, we've got loads of data here from other areas like Brazil, for example. Brazilian GDP is going to be hitting the wires. Or not GDP, debt to GDP, I should say. Brazil hiked rates again this week, continuing to battle a phenomenally harsh inflation problem. Pretty much one of the only countries in the world that have any inflation. Everybody else has got the opposite problem. But Brazil battling high inflation, hiking rates yet again. That's multiple hikes this year already, and they still haven't got this inflation problem under control. Really hurting the Brazilian economy. And obviously then you get the double whammy of the fact that Brazil are a giant sort of commodity and resource exporter, and when you've got commodities and food prices sharply lower, this is having they're not having a great time of it. But most important for the markets we're looking at, we've got Chicago PMI data at 245. We're expecting an improvement on last month's bad number, 49.4 last month. We're looking for that to jump back above 50 to 50.8, so we'll talk about that nearer the time. We then have University of Michigan consumer sentiment data. We got bad consumer confidence numbers earlier in the week. This consumer sentiment data is expected to be at 94. This is the final reading for this month, though. We already had a mid-month reading, which came in at 93.3. This was the preliminary number. This is the final one, okay? So normally the final Michigan number isn't as market sensitive because we already had the preliminary number a couple of weeks ago. So it'll be the Chicago PMI number that will be the most influential on markets this afternoon, but only, of course, if it comes in, out of line with expectations. So that's the data calendar. So wrapping up the month, we might get some month-end flow activity as well, but as it stands at the moment, if we quickly kind of just zoom in a bit on some of these markets, you've got the German DAX just tracking on the low of the session right now. We had those weak month-on-month retail sales figures earlier. The DAX is testing the low just above the pivot level. And so there we go. Stocks on the back foot. Enjoy the session, guys.